And, you know, though that's 5.5 to 6.5% of GDP. We've never experienced those numbers in the past, except during the height of COVID. So this is really quite a different environment that we're in today than we've been in ever before, unless it was World War II, when the deficits were pretty big. We also have consumers fighting it. I mean, we're as guilty as the president and Congress. Okay. We are spending money like crazy. And that's just a fact. We are, after COVID, and we saw that, you know, it's funny, we saw this 100 years ago when we had the Spanish flu pandemic in 1918, 1919. And what followed that period we called what? The Roaring Twenties. When you get a scare like that, people say, well, what am I saving for? Well, I already had the rainy day. It's now time to enjoy what's left. And so we've got people doing all kinds of experiences and saying, well, I'm going to do what I want to do. I'm not waiting for things to get better. So we've been fighting it just like we've been fighting the Fed, just like Congress. The stock market is obviously fighting, and it's been going up. You know, usually you think of the market on average going up 7.5% a year. In the last couple of years, it's been going up by more than 10% each year. And finally, we've had labor unions, the labor market and unions. I just saw the other day that, I forget the company, that's getting ready to strike, that wants a 40% increase over 4 years. That's 10% per year. And we've already seen that from Delta, American pilots, the UAW, UPS. We've all seen, you know, 8 to 10% wage increases over the next 4 years in their recent contracts. All right. So here is fighting the Fed by the president and Congress. These are all of the Biden administration bills that have been passed. And I want to be careful here when we look at this Inflation Reduction Act. I'll talk about it in just a second. But over $4.8 trillion in new spending. Okay. Only this act allegedly has pay-fors in it. All the others have no pay-fors in them. So they are just pure deficit spending. Okay. And this is the initial CBO 10-year estimate. Okay. And more indication is suggesting that this is now actually turning, unfortunately, positive in terms of a deficit situation, that the pay-fors didn't turn out to work as well as they were expected to work. All right. So what we've seen is obviously a big deficit, over $3 trillion back in 2020. By the time 2022 came around, we were 1.3 trillion. Something I think we can live with. But you can see the last couple of years we've been pushing towards the 2 trillion mark. And this is beginning to get into that 5.5% of GDP range. And then as you see here, and this is just basic, no recessions. All right. This is based on GDP growth and current law. This doesn't take into account what the next president might do in terms of fulfilling their promises that they're making to all of us about how they're going to make our lives great. Okay. And so by the end of this 10-year period, 10 years from now, we're looking at over a $3 trillion deficit without the recession that we had during the COVID years. Something to keep. This is the Fed itself. Okay, and their balance sheet, it got up to just under $9 trillion during the height of COVID in terms of buying up debt and essentially accommodating federal debt during the COVID years. And fortunately, they are in the process of getting the balance sheet back down. I don't know that they'll ever make it back to pre-pandemic levels, certainly not anytime soon. But the more they do this, the more they can continue to trend downward in terms of the size of the Fed balance sheet, the more tools they'll have in their quiver for down the road if, in fact, they need to fight a recession. Okay. Personal consumption expenditures. This is us. This is you and me. You see it dipped here during the during the COVID recession, dipped a little bit in 21 in the spring. But ever since the vaccines have been out, you can see it's just relentlessly increasing, continuing to increase. We're spending more and more as consumers day in and day out. Dow Jones Industrial Average, the stock market back here took a big hit during COVID, and it's been running up ever since that. Okay, and that was the Dow number about 3 days ago. All right, so what's the Fed going to do? Everybody's anticipating. I think everybody here has a bet as to whether it's going to be 25 basis points or 50 basis points, but I don't think anybody believes that when they meet in a couple of weeks, they're going to do nothing. Okay. And I think that's a pretty good bet. All right. So here's the inflation rate again. They say they're targeting 2%. They're still not there yet. But the question has become, this is in my mind anyway. All right, this thing has been bouncing around here for the last almost year, right around 3.5%, both the core and the overall CPI. There doesn't seem to have been a lot of progress. You can see that we got a lot of progress in 2022 through the early part of 23. We brought the rate down considerably, but it seems to have been stalled for the last year or so. Yeah, some months the number will look good below a little 3%. Okay, then it'll pop up above 3% and so on. But it's been kind of sticky at that. And the question always becomes, has disinflation stalled? And that's prices rising at a slower rate. Okay, has it stalled? Are we stuck somewhere around 3% at this point? And the second question is, I always worry about this. You know, these numbers have been stall. Is there anything here that's going to start to send them back up again? That's always a concern. So is inflation returning? All right. This is something called the San Francisco Fed Inflation Dispersion Index. It's basically looking at all the stuff that's in the CPI market basket and looking at what percentage of it prices are going up and what percentage of prices are coming down. Okay, and that leads to the overall. And you can still see that there really hasn't been a big change. And in fact, in the last couple of months, you've seen the percent of prices rising from where it was in the first half of the year. Okay, so that is a little disconcerting that roughly 2/3 of prices are still rising, only 1/3 are coming down. So, recession uncertainty and economic headwinds. What are we looking at here? Consumer confidence, energy prices, inflation, wage catch-up, the Fed operating deficit that we talked about before. Here we go. All right. So this is the Michigan Consumer Sentiment. This is basically surveying consumers and asking them a real simple question. Are they interested in purchasing big ticket items? Because the higher percentage of people that say they're going to buy a big ticket item in the next 6 months, the stronger it is believed consumers, the stronger position they believe consumers are in. And consumers are 70% of our economy. And what we've seen here in recent months is it's starting to come down again. And that is quite frankly very disconcerting. All right. It was down real low during, as you can see, the COVID years, but it's been rising since then, reached 79. By the way, 100 is sort of the normal here. Excuse me. But it's whoop. Don't like this thing. Right. All right. One more. I'm working on this. You were right, Tim. He advised me that I wasn't going to like this clicker. I got a big thumb and I got small buttons, and so it's not working out real good. All right, so I got to go back one more. So it's 68.2, the most recent one. It's a little disconcerting. I think that, and that wasn't February of 2004. That was actually the July number. And what we've got here is sort of an interesting situation with oil prices. Oil prices have been coming down since their peak in early 2022. As I said, when this chart was made last Friday, West Texas was $76 for the month. I noticed that the daily rate this morning was $70 and change. So oil prices are coming down. You can see the gas prices. It's easy to buy gas now at less than $3 a gallon for regular, around here anyway. So, you know, oil prices are coming down. That's probably a good thing that will spur consumption. So, but we've got a little bit of a problem here, and that is there's an 800-pound gorilla in the room that nobody really talks about. As far as I know, I'm about the only one that talks about it. And that is that the Fed historically has been able to, they don't have a budget line from the US government. Fed is a bank that is owned by the banks. There are 12 Federal Reserve District banks. Each one is essentially owned by the banks in that district. And it has to fund its own operations. And it does that through the buying and selling of bonds and making money doing that, but also does that by providing services to the banks like check clearing and some other services that you don't need to worry about. But they make money, and if they make more money than they spent, they return that to the government treasury at the end of the year. And they've been doing that for a century now. The problem is that in 2022, the Fed handed back $76 billion, but by 2023, with a higher interest rates, the Fed has in fact been running annual deficits. They can't cover their costs. And so the Fed has lost 58.8 billion in 22 and 114 billion in 23. I can do the math there. That's almost $200 billion in the hole in terms of their operating budget, which is significant. And they got in that position because they've raised rates so high, but their portfolio, remember, it's down now to less than $8 trillion, but their portfolio is made up of bonds that are only paying 2% because they were bought a long time ago. And now bonds are paying 4 or 5%, 4 and change percent. And so those bonds are worth less today than they were when they bought them. And that's the deficit that they're running into. Some analysts see the net loss peaking at around the 200 billion range. But this is a pressure that means the Fed might start to relax interest rates sooner rather than later. I think we're going to see that. The next meeting is September 17th, 18th, then November 6th and 7th, and then December 17, 18, and then the first one in 25 is in January, the end of January. So how many rate cuts and how big are those rate cuts going to be? My suspicion is that we're going to see 25 basis points in September, November, and probably December. Now, tomorrow we're going to get a jobs number. And we pretty much already know what that jobs number is. Probably 160,000 jobs tomorrow. You can set your clock or get an alert at 8:30. The Labor Department, the Bureau of Labor Statistics will release that number. I wake up with it every first Friday of the month. You'll see that probably somewhere around 160,000 jobs will be created for the month of August. That's better than what we had in July, where it's 118, and makes the July number an outlier. The July number scared a lot of folks that were heading for a recession, okay? Because that number was pretty tepid. But as I say, I think we're looking probably at 160,000 now. And if that turns out to be the case when the number comes in, there's going to be less pressure on the Fed to do something. But I think they've already signaled so strongly that they're going to reduce rates, that they're going to come down by 25 basis points. The question is, do they have 2 or 3 before the end of the year? I guarantee you we're going to get 1 in September, guarantee 1 in December. The question is, will they do 1 in November, which is right around the election time? Who knows? But we could see as much as 75 basis point reduction, which would bring it down from 5.25 to 5.5, back down to 4.5. And, that would be a significant decline. We are not sure what the neutral rate is now. And what I mean by the neutral rate is either non-inflationary or non-deflationary, okay, or disinflationary. Probably somewhere around 4 to 4.5%. So we've got some ways to go to bring that, the Fed has ways to go to bring that rate down. But I would not be surprised to see 3 cuts this year, 2 guaranteed, and a possibility of a 3rd. All right. So here's what the Fed's got going for them. If they lower the rate, there's an increased likelihood of a soft landing, which is good. All right. Reduces federal losses. right? Which is good because the rates are lower. Therefore, rates will go down and the bonds they have that are I mean, essentially what the Fed is sitting there with is a balance sheet that looks like Silicon Valley Bank. You remember that a year ago? That's essentially what the Fed has. They got long-term bonds paying 2.5% on their balance sheet. Okay. When current rates are 5%. You can do the math on that, right? So it reduces Fed losses and it increases the risk of inflation going forward. That's the downside of it. If they keep rates at current levels, they'll most likely could keep inflation from rising. Not sure they're actually going to bring it down below the 3% level. Not 100% clear of that, but there'll be a possibility of a recession. And it will also lead to increasing Fed losses because their balance sheet won't get any better, right? So those are all the things that are going on in terms of the Fed making decisions in the next couple of months. Oh, that wasn't what we wanted to do. All right, is a recession on the horizon? I think that's the big thing everybody's worried about. Okay, everybody heard about the adjustment that took place in the jobs numbers about 2 weeks ago, where they said, oh, there are 818,000 fewer jobs that were created than we thought there were. Okay, everybody needs to sit down and relax on that. That's no big deal. And if you look at the numbers in the Bureau of Labor Statistics right now, you'll notice that they haven't changed any of the numbers. In fact, the March number, which this pertains to, is still the same as it was before the benchmarking. All they did was say, look, we've started our benchmarking process, and in March of 24, okay, what we're indicating is that there are actually 818,000 fewer jobs at that point than we thought there were. Now, it's only a 5%, or excuse me, a 0.5% adjustment, okay? But what's interesting about it, and this goes on all the time, but we don't know how many fewer jobs there are today than we are telling you that there are. But you have to understand, this is a survey. We want timely information. So Friday, tomorrow, we're going to get the jobs number for August. You don't want to wait until next April to get the jobs number for August, right? You want to know what we think is going on. And so it's based on a survey. About 30% of firms are surveyed, okay? And from that, they make projections as to what's going on. What's really interesting here is not that the number came down by 818,000. What's really interesting here, make sure I hit the right button, is the impact that it had. So a lot of industries, yeah, they lost 100,000 here, 100,000 there. But you notice business and professional services was the big one, okay, which was 358,000 fewer, along with leisure and hospitality. In other words, we were really messing up the estimates in those sectors. Okay, more than half of the adjustments taking place in just 2 sectors. Most of the rest of the sectors, we've done a pretty good job on the estimation side. But in those 2 sectors, we really didn't have a clue of what was transpiring and how the survey numbers should be tracking the overall numbers. It'll be another couple of months before we get all new employment numbers, but it's not that big a deal. As I said, it's only a 0.5%, instead of 158 million people being employed in establishments in the country. It's 157 million. A lot of people, okay? All right. What indicators does the National Bureau of Economic Research use to determine a recession? Everybody here has heard of the 2 quarters decline in real GDP, right? You all heard. That's a rule of thumb, but that's not anything that these guys looked at. So it turns out these are the 6 that they look at, and I don't see anywhere, I'm looking, I don't see GDP there anywhere, do we? I don't see it, okay? So let's take a look at how these have been tracking over the last. All right, so here's real personal income less transfers. That's going up. Don't think we have to worry about that. This is payroll employment. Oh, it's going up. We're going to add another 160 tomorrow. That's good. So that's going up. Real personal consumption expenditures. That's going up. Manufacturing and trade sales. That's been a little flat and bumpy, but it's not going down. let's see, household employment, that's another survey concurrent with the establishment employment survey that everybody hears about. All right, that produces the unemployment rate. Household employment is holding pretty steady, and industrial production is holding pretty steady. So I don't see any of the 6 things that the NBER look at to suggest that, you know what, we got trouble on the horizon, because we don't. So everything seems to be the indicators that we would look at to determine whether recession is on the way. We don't seem to be having a problem. Now, here's consumer debt. All right. And this is always something that people worry about. And this is the trend coming out before COVID. Okay. So just follow that trend along. Boom, 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 boom. And you can see that consumer debt is now a little bit above where it would have been but for COVID. All right. So that's a little bit of a concern, because at some point in time, maybe you have to pay that back, or maybe you're like the U.S. government and you never really have to pay it back. I don't know. There are a lot of ads on TV telling you if you got debt, just call this number and we'll take care of it. I missed something there, but anyway. But here's the delinquency rate on consumer loans. This is the peak back in the COVID when things were, people actually lost their jobs and didn't get paid. And it's been rising ever since. There's about 2.74% of consumer loans are behind in their payments. So that is a little bit of a concern. But again, NBER doesn't look at that, but that's something that suggests that maybe consumers are starting to run out of gas. Okay. Interesting enough, here are some state unemployment rates. And there are just a lot of states that have incredibly low unemployment rates. I mean, look at these. Okay. Look at all these states. North Carolina is doing a lot better than the U.S. at 4.2%. And here's a bunch of states that have higher unemployment rates. I just throw this out because apparently how you think the economy is doing may have a lot to do with where you live, as opposed to kind of the overall national. It'd be hard pressed to suggest that with a 4.2% rate of unemployment, creating 160,000 jobs and 2.5% GDP growth consistently, that there's something wrong with the economy. But if you live in one of these states, New Jersey, Washington, California, Illinois, Nevada, and the DC, you might have a completely different perspective on it, because you've got unemployment rates here. I mean, you got several states right here that are over 5% rate of unemployment. Okay. All right. All right. Outlook for 25 for North Carolina. I'm looking at it better. Now, you got to take this for what it's worth. The problem we have here is we have no idea who's going to be elected president in November. Okay. Y'all get your coins out, flip it. That's as good as we got. All right. And they all have agendas. But here's the thing, if you're trying to do some forecasting, likelihood is no matter who wins, it's going to be a deadlock government. They're not going to win both houses and the presidency, whether it's Democrats or Republicans. All right. So let's assume that the Democrats get the House and get the presidency. There's almost no chance in heck that they'll keep the Senate. It's already back to 50-50 when Manchin retired. The math doesn't work for Democrats this election year. There are 34 seats up. All right, 23 of them are Democratic seats, only 11 are, and they're all solid red. So, and 3 are sort of neutral. We have no idea. So it's 50-50. And then 3 states, Michigan, Ohio, I forget the last one, are all in play. All right. So so what I do is say, well, I don't really think things are going to change very much from what we've got right now for 2025. We can talk about this a little later. So what I'm thinking is that we're going to see basically more of what we saw last year, modest 2% growth, which is about what we can expect in a good economy these days, given the demographics and productivity levels. 2.5% is about what we can expect. I'm a little bit concerned that, so overall, that's the growth rate. Information is one of the big sectors again in terms of growth. Most of the rest of the sectors are going to have fairly modest growth. What you'll notice is all of the sectors, all 15 sectors, are indicating growth in 2025. All right. However, Job growth is down a little bit, maybe only 53,000, which is considerably off from where we were. So definitely the economy is going to be slowing a little bit, but I don't really think there's going to be a recession going forward in 2025. After that, all bets are off for a couple of reasons I'll talk about in just a minute. The unemployment rate right now, we're at 3.7% in this state. I think we'll hit 4% by the end of the year because unemployment rates are rising, and probably about 4.3% by the end of 25. Again, those numbers are not a problem and certainly not indicators of a recession. So what should we look for going forward? Rate cuts. How much and how many? Energy price wild card. I still don't know, and I don't think anybody knows what's going to happen in the Mideast. There seems to be kind of a lull right now, but we do know that Suez Canal is essentially shut down, and that does affect transportation through there for oil, et cetera. Consumer confidence will come out again at the end of September. I'm very curious as to whether or not that number will come up or not. Monthly job growth will come out tomorrow. Expect 160,000. The August inflation number, which will be important for the Fed meeting, comes out a week before they meet. Fiscal year 25 budget. I don't know whether any of you have figured this out or not, but we're supposed to have a budget by October 1st. I think the clock is ticking. So we're not going to have a budget. We're probably going to have a continuing resolution, or maybe the government shuts down. Seriously. Okay. So that's kind of a wild card. And then third quarter GDP will come out just before the election, although I think most of you will have voted by the time third quarter GDP comes out on October 30th, 2024. All right. So key takeaways to this: exogenous shocks matter. Oil prices could catch us out on a limb. Escalation of tensions in the Mideast could, again, cause us problems. Fed policy matters. I think there's a 50-50 chance of return of inflation in 25. So I think there is a possibility we'll start to see. I don't think we'll see 9% again, but we could see 3.5%, 4% creep back in 25. And finally, I think there's a very low chance of a recession in 2025. All right. Now, later on in subsequent forecasts, we'll start talking about 26. I think the chances for recession are higher in 26 than they are in 25 for a variety of reasons, which have really nothing to do with the economy, but have a lot to do with the tax situation. When the Trump tax cuts disappear, which they are going to do at the end of 25. Okay. How many of you remember that's a Lewis F. Harrelson guarantee? Raise your hands. Okay. Yeah. So some old charlatans can remember that commercial, right? It doesn't matter who wins. There's not going to be it's going to be divided government. There's not going to be enough votes to continue that. It's not going to affect you and me very much. Okay. But it is going to affect corporations and small business. There's two critical things are going to take place. One's the corporate rate's going to go from 21 back to 35. Okay. And that's going to affect CapEx and employment numbers. And number two, the 20% pass through for us, small business proprietorships and partnerships goes away. And those are all things that are going to be problematic in 26, but not in 25. All righty. That's it. All right. Good news. Good news is the next year and change, everything's fine, no matter what happens this November. After that, all bets are off. And I'll be happy to answer any questions that you all have. You're moderating. All right.
All right. So with that, thank you, John. We appreciate it. Thank you very much.
All right. Thank you.
All right. And with that, we will take questions from the floor or from the Zoom feed. So we have people with microphones who can answer anything. So any questions? We've got somebody here on the right. My right. Guess that's technically stage right.
Oh, I have no idea how that works.
First off, great job.
Thank
This
you.
is my first economic forecast, so that was a master class. I have several questions, but I don't want to hog the mic, so I'll come back if we need extra space. So there was one slide on there that showed that personal consumption's higher, right? But then consumer sentiment, so we're asking consumers whether they're going to buy expensive
Big ticket
items.
Yeah.
So how, I guess both could be true, right?
Yes.
But, okay, so that answers my question then.
Yeah, both can be true because big ticket items are different from what you and I are doing. You know, we honestly expected travel to be down this summer. And it wasn't. All you had to do was hit an airport one time and you knew that wasn't the case. People are traveling. Okay. That's a different, you know, these indexes like the Michigan Consumer Index and Conference Board Consumer Index, these things were designed decades, almost centuries ago. And they don't take into account the spending habits, you know, that we are into now. And so, you know, the fact that we are buying experiences more so than we are buying things, is driving that consumer expenditure number. And it doesn't get picked up. You know, people aren't buying cars. Okay. People aren't buying houses. And except in our household, people aren't buying refrigerators. Hey, look, it lasted. The last one I bought was in 1991. It lasted that long. I got no complaints. Okay. But my wife said, it's time.
So do you have another question?
Yeah, but I don't want to monopolize. I guess just real quick, consumer debt's rising, right?
Yeah.
Interest rates are higher. I keep getting credit card stuff in the mail, as I'm sure all of you do. I think I saw like 28% APR on a credit card. So I guess what happens, like if consumer debt continues to increase, you have a shock to the economy or challenges. How do people keep
Yeah,
up
it's
with
not the
higher
consumer,
rates for
it's not the
longer?
consumer debt. We worry about it nearly as much as we worry about the delinquency rate. That's the real killer in this. And we're starting to see the delinquency rate rise as that slide showed. I don't think at this point in time, it's really out of, you know, not handing out of a problem. I think that when we start seeing a 3% delinquency rate or above, I think that's when we start to see a real problem in the economy, because that's when banks start losing money. I mean, they've got priced into their risk delinquencies. And as long as it stays in the 2.5%, even 2.75% range, it doesn't really affect their bottom line. And so I mean, of all the companies that you see laying people off right now, some of the tech companies, some other companies are talking about layoffs, not banks. Okay. So they're still clicking along. Their formulas seem to be working, but when that delinquency rate gets up above 3%, that's when they start having to look at profitability and really they can't make those people pay. So they start laying people off and that starts to tumble down. I don't know whether it's going to get above that, but if you looked at that slide, the trend is it's rising. Any other question?
Go ahead, John. We'll get to you in a second, Devin. John, we have one from the web. So I'm going to answer that. So let you answer it. So the question is, isn't the stock market inaccurately forecasting the risks ahead of us based on what you've just discussed?
That's an interesting question. I think there are a lot of folks out there that think that there's a lot of risk in this election. And I've always tried to stay away from politics on this, but I don't see the next 2 years as being any different than the last 2 years, regardless of who gets elected, because we are going to have divided government. And while presidential executive orders may be problematic emotionally to you, as far as affecting the economy, it's not that big a deal. Okay. And so I just don't really see, look, I'm going to throw this out. Raising taxes, which I've heard one of the candidates suggesting that he or she wants to do, is not good for the economy, right? We know that. We've seen that. The other candidate wants to raise tariffs. We know that doesn't work either. That's not good for the economy. We've seen that. Okay. And so it doesn't matter who gets elected. They're not going to be able to do what they want to do because they're not going to have Congress on their side. Chances are Democrats are going to win the House. Republicans are going to control the Senate. It's going to be divided government, just like the last couple of years. And we're not going to be able to pass a budget or anything else. And for an economist, that's great because it's stability. Right? It's easier to forecast. Okay? All right. Sorry, that's as political as I'm going to get, by the way.
Well, again, thank you very much for coming out today. Two questions, if I can, I'll ask one, and then if we have another, I'll come back later. But more on the side of maybe technical, not necessarily forecasting. Can you explain to me? I generally understand what GDP is, but when you were talking about the output, specifically with North Carolina, and how you measure the output for the fire industries, for
Finance,
example.
insurance, and real estate, yeah.
And you said they're producing the most output that's contributing to North Carolina's GDP. What is being measured?
What is being measured? The value of the products that they sell. So if you do business with a financial institution, okay, they sell you services. So if you do business with, let's just say Bank of America, okay, they sell you a checking account, which has, and you pay for it one way or the other. You either have a minimum balance or you pay a monthly fee. That's what we're picking up there. If you have a stock brokerage arrangement with Bank of America or Wells Fargo, okay, they sell you services and they charge you for those services. All right. If you borrow money for your car, you're paying an interest rate, which is what the bank is. That's their value added, if you will. Okay. So all of those things where the bank is making money, okay, adding value is what we're measuring. GDP, gross domestic product, is essentially the same thing as value added, right? The value that's being added by a firm in any business or industry. Okay.
Okay.
Go ahead.
Good for a second. Okay. And then another question. This is just so forgive me if this just sounds kind of like asinine, but I'm going to ask it. So we were talking about the Fed's balance sheet, and you were talking about how originally at one point it was around 3 trillion, then it ballooned up to 8 trillion. That's a little bit below 8. What, a two-part question here. What are the implications of them just writing off, $5 trillion and getting it back down to 3? And isn't that what they do already? Like, don't they just write things off? Like,
Okay. Let's answer the first one first, and we'll leave the. Okay, so I'm old enough to remember prior to the Great Recession in 2008, the Fed balance sheet at that time was $800 billion, less than $1 trillion. And it rose up to $4.5 trillion during that. Again, trying to grease, if you will, the economy. What the Fed does during those periods of time is they accommodate federal deficit spending by buying up the bonds, okay, that the Treasury is. Now, it's illegal, technically illegal for the Federal Reserve Bank to participate in the Treasury auctions to sell when they sell bonds. Okay. They can't directly buy Treasury bonds at the auction, but others do buy them. And then they accommodate by buying up in the secondary market. They're allowed to buy in the secondary market. It's kind of like, don't look what's going on over here. This is what we're doing over here. Okay. But they are by buying other bonds, federal government bonds. All right. They're making it easier for the Treasury to run deficits during periods of economic decline, which is what we saw in 2008, 9, and 10, and also what we saw during COVID. Second thing that they do, and they started doing this, excuse me for just a second. Second thing that they did and started for the first time in 2008 and 9 was buying mortgage-backed securities and even buying car loans, okay, which is totally unprecedented by the Federal Reserve. But it was, again, trying to ease credit markets and make credit easier to obtain. And this is how their balance sheet got so big. The problem is that for most of this time, it was fine because there wasn't a big difference between, and this gets horribly technical, but there wasn't a big difference between what the interest rates on the products that they were buying were, okay, 2, 3, 4%, and what they were having to pay out in terms of what they call interest on reserves, which is a new program the Fed instituted back in 2008. So, all right, so you're the Bank of America, you're the Fed, you have reserves, cash that you deposit at the Fed, all right? So you got $1 billion over there, $1 billion, $1 billion. So you're Bank of America, right? you're going to pay them interest on that because you don't want that money out there for whatever reason. All right. And by adjusting that interest rate that you're paying, you can affect how much Bank of America has to lend out. Okay. And to make credit easier or to make it harder. So you want to slow the economy, you raise the rate you pay, they give it to you because it's risk-free. Okay. You want them to expand the economy, make credit easier, you lower your rate, etc. Problem we have right now is that the rate they're getting from the bonds that they own on their balance sheet is 2 and 3%, but they're having to pay out 5% to Tim over here. That's why they're losing money. Okay. And that's not going to go away anytime soon. That's what happened to Silicon Valley Bank. They had bought a lot of treasuries back at the beginning, when money started flowing in, all the cash giveaways that were taking place during COVID. And they said, well, we'll do something safe. We'll buy long-term treasuries. The problem is, as the Fed started to raise interest rates, they had to pay more to their depositors than these treasuries were paying. And as a result of that, they wound up in the same position the Fed is in right now. Fed can lose that money. I don't know actually how they do that, but they get IOUs. They give IOUs to the, honest to God, they give IOUs to the Treasury. Oh, sorry, guys, we need a couple $100 million. Don't worry, we'll give it back to you. Okay. I mean, nobody asks questions about this stuff. Okay. I'm a little pulsed by it, but that's what's going on here. Okay. How long it can go on, I don't know.
John, we got time for one more question.
Oh,
There's a
sorry.
great follow-up to that question, actually. So maybe you could answer. This is also from cyberspaces.
Cyberspace.
If the Fed is owned by the banks in their region, their district, and the Fed is not making money, how does that affect the bank's bottom lines?
Well, it can't affect the bank's bottom lines, but it could, because technically they're the shareholders and they would have to contribute more capital if it were a regular business. But somehow or other, the Fed's able to write these IOUs to the Treasury. These are financial doings on that are way above my pay grade, to be honest with you. I know how it takes place, but I don't understand how it's allowed to take place. You're right about it. I mean, technically it should be the same as every other private business in that the stockholders, the owners should contribute the capital to keep it afloat. But, and I will say this, for decades, the Fed has been returning cash to the Treasury. So, if you think about it for a while, they've returned a gazillion dollars, somewhere in the order of 50 to 100 billion a year to the Treasury. Asking them to, extend out a couple $100 billion for a little while is probably not wrong. Okay.
Well, John, thank you very much for your insights today. And thank you to everybody here for joining us for the North Carolina Economic Forecast. Hey, if you or your firm would like to engage further with the Belk College of Business and our mission to produce talent, the expertise, and the impactful research to fuel economic growth in the Charlotte region, please reach out to me. We have lots of ways we connect with the business community, and we are excited to be your partner and want to be an active partner with the Charlotte business community. So that concludes our program for today. Thank you very much for coming, and we look forward to seeing you.
I have, in December, but I have one last thing to say. A lot of times people come down and talk to me. You need to know I'm sick.
It's 3 foot distance.
We're going back to, I don't have COVID. I took the test. I'm fine. I just got a cold. Okay. So just, don't want to give it to anybody. Thank you.
Thank you.